Hey everyone, in today's video, I'm going to be going through 12 Canadian stocks that have been absolutely collapsing over the last month. We're going to go through what stocks these are, what these businesses do, before going over their valuations and what their kind of trading price to earnings multiples are, before I give some final thoughts on each of these stocks. The objective of the video is hopefully one or two of these companies seem enticing to you. You may do more research on it, add it to your watch list, whatever that may be, and just kind of tips you off to just some of these recent moves in the market. So we're going to get right into this. But before that, be sure to give this video a big thumbs up if you like this kind of content. It really helps grow the channel, and I appreciate it a lot. So I'll just give you a second to do that. But we are going to start here with Savaria Corporation. Savaria Corporation is a company that's all about the mobility space, specifically for people in their later years, like elders. They operate businesses that put elevators into people's homes, things that can help people get up and down stairs easier. Lots of their business, or about 10% of their business, is on lifts that get people with wheelchairs into vehicles easier. So you may see their brand on the back of vehicles that have been adjusted for that use case and whatnot. So they're really in that space. They also own accessory businesses that sell like hospital beds, canes, and stuff like that to consumers, but primarily they're in the lift business, stair lift, elevators for residential and commercial use, just to help people later in life stay at home longer, make it easier for them to get around and just enjoy their later years. So obviously, based off the type of business that they really have a great secular tailwind, as lots of the American and Canadian economies have aging baby boomers and consumers. These kinds of products, you'd think over the next 5, 10, 15 years will become more and more in demand. Another thing with Savaria is, especially here in Canada, where we had so many issues during the pandemic in terms of the quality of the old age homes and retirement homes in the country, I think that's another thing that with time will really play into Savaria's hand, because more people will want to stay at home longer. They won't want to be exposed to those kinds of environments and whatnot, based off of just kind of what some of the messaging coming out during the pandemic was all about. So you're getting a starting yield of about 4%, and they do pay a monthly yield here. Current market cap is about $900 million. Looking at this one, it actually was doing pretty decently, was up at $17 just a few months ago, but has recently collapsed down to $13. You can look at it over the longer term here. Had a huge run up, and since then dipped down, really went up a lot in 2021, and it's been a bit volatile. They've done a lot of acquisitions in Europe on like elevator and lift companies, and they've recently opened up a new facility in Mexico. Before that, lots of their lifts were being made in China, so they wanted to geographically diversify their supply chain for obvious reasons, especially with lots more turmoil happening with China geopolitically, with America and stuff like that. And in addition to that, Mexico is just so much locationally closer that the shipping is probably significantly cheaper to support at least the home market of Canada. So this is a company here that, while it's gone on a really nice rise over the last 10 years or so, it's really stagnated over the last 5 years. You see here that's actually down. If I include the dividend, it's about dead money over the last 5 years. You're probably about flat overall as an investor, but the valuations come down significantly. So looking at their current valuation, they're expected to do about 80 to 90 cents next year, so trading at about 14 times. Historically, just given the long-term tailwinds in this business, they're trading at 25 times-ish, so the valuation's almost cut in half. And obviously some of that's due to interest rates and cost of capital and opportunity cost with GICs and treasury bills. But overall, it seems like an interesting value proposition to invest in at these levels, especially if we think that the EPS will continue to go up. They've talked about trying to get a lot more scale on their Mexico plant to increase margins. They've had a margin hit recently with moving to that. But overall, you see here 55 cents of EPS last year, 61 cents expected this year, 86 cents next year. So they're definitely trending in the right direction on this one, despite being down 10% in the last month. The second stock is Magna International. Magna International is a car parts company, big business, about $20 billion market cap, paying a 3.6% dividend yield here. It is down over 7% in the last month. You see it really kind of dropped off of a cliff recently in the last few weeks or so, last week or so. In the last year, it's about flat. Last 5 years, it's actually done pretty well. Well, decent. At least it's up a couple percent a year. Plus, you've been getting the 3-4% dividend. So it's been an average performer, let's call it. Looking at their earnings per share estimate, they're expected to do about $9 next year. So $9 next year puts them at about 8 times next year's earnings. So really attractive valuation from a price to earnings standpoint. But these companies get disproportionately hurt when the auto industry gets hurt. Also, I'm not sure how well positioned they are for electric vehicles, and as that kind of takes market share, I think lots of those parts are directly with the manufacturer, so maybe they get cut out of that arrangement. But ultimately, over the longer term, this company's been able to stay relevant, and they've actually done phenomenally well when you look at it over a 10, 20-year standpoint. And this may just be a good opportunity at these lower multiples for them to continue to buy back their shares, which they do a lot of, continue to increase their dividend, and just compound that shareholder value for patient investors. But with that being said, it definitely has not been a great month if you already hold the stock. On to number 3, it is Colliers International Group. So this is a real estate service company for the most part. In the last month, they're down 16-17%. Not sure if that's based off like interest rates going up may make it less likely that people are selling their homes. If they are selling their homes, probably for lower prices because the cost to carry those homes will go up, which will impact commissions and auction prices and stuff like that. So we can see it's been a pretty tough month here, down 17%. In the last year, actually wasn't doing too bad until that last month really crushed them. And still in the last 5 years, they've been doing decently, up about 9% a year, give or take. They don't really pay a dividend though, so this is your total return. Looking at their earnings per share, they're expected to do about $10, so trading at about 12 times future earnings, closer to 15 times current year earnings on this name here. Looks like their earnings are pretty volatile. You can see here, even last year, they did about $9.50, so they're actually down this year. So keep an eye on that, maybe some cyclicality around the real estate space. Interest rate will expose you to a volatility and fluctuations on those EPS numbers. On to Molson Coors. So this is the US ticker because that's what has the most liquidity, but Molson Coors is a Canadian company. Stock's down 10% here in the last month. You see they're paying a 2.8% dividend yield here, $12 billion company, and trading on the bottom half of their 52-week range at least. Molson Coors owns tons of beer brands, some seltzer brands as well. I think they own brands like Vizzy on seltzers, but obviously Molson Canadian, Coors Light, et cetera, would be in their ownership structure. Going into their EPS here, I will go to the US one since that was the equity chart we were looking at, but expected to do an EPS number of, drumroll please, you can see here that they've just been slowly trending down, about $5 next year. So trading at about 12 times earnings here. When you compare that to like an Anheuser-Busch or some of these other liquor companies, lots of them tend to trade closer to like 20 times. So I thought it was an interesting stock at this level. You can see here their EPS last year was $4. This year is going to be $5. Next year is $5.20. So they've also been trending in the right direction in terms of their growth. Going on to the next stock, it is Rogers Communication. Rogers was down another 7.5% this month. Looking at Rogers a bit longer term, they're down 20% in the last 6 months. Even after they finished the Shaw acquisition, which lots of investors were quite bullish about, we've seen them drop pretty heavily, maybe because they're just in an industry that has lots of debt, but it's really priced them down to a point where they're paying almost a 4% dividend yield. This company, in addition to telecommunications, also owns some really great underlying media assets, whether that's the Toronto Blue Jays, they're the sole owner of, or they own about 35% or so of Maple Leaf Sports Entertainment, which owns the Raptors, the Leafs, Toronto Football Club, and whatnot. So they do own some great media assets as well. Looking at their EPS, did about $3.75 last year, going to grow about 20% to $4.40 this year. Next year, expecting over $5. So really great traction on EPS growth. And at $5.20, Rogers is trading at 10 times earnings. So this is a huge company, lots of recurring revenue, trading at a really nice valuation here, in my opinion. This is actually one that I may be adding to my watch list to buy more of if it gets to this 4% dividend yield, 10 times earnings, sustainably over an extended period of time. I may not be able to help myself, but nibble in a bit on this one here. Going to the next one, it is Opentext Corp. This company owns tons of software businesses. They kind of do a lot of acquisitions, amalgamate it all together, drive synergies on the back end, and just complement the services to cross-sell customers, I believe. You see here they're down about 8% in the last month. Going year to date, though, the company's actually beat the market, up over 11% year to date. They also pay a nice 3% dividend yield, and they trade at a $12 billion market cap. So a nice little home Canadian tech play here, if you will. Looking at their EPS, pretty good valuation here, trading at or expected to do $5 of EPS next year. That's only about 7 times their current stock price. And this is they are also traded on the NASDAQ, so this is their NASDAQ EPS and price, but it should correlate to the Canadian stock as well. Also some nice growth, 470 to 510, did 330 the year prior. So this is a really interesting one that I may want to look into a bit more, do some more research on their business and why they're trading at this kind of valuation. The next one is actually a stock I own as a disclaimer. It is Riocan REIT. This is a real estate play. And as a full disclaimer, I've gotten absolutely crushed on almost all my REITs in the last year. You see here, Riocan was up at $23, down about 30% here to $17 a share. Lots of concern on just any company that has a fundamental reliance on debt, given where interest rates are and where interest rates may go. But in my opinion, these REITs, especially the very large ones that it's really hard to take down, just given the amount of assets, the amount of cash flow, their tenant base coming in, big companies, groceries chains and whatnot that are pretty locked into paying rent, and the real estate's really fundamental to their business as well, so they're definitely going to keep paying rent. Trading at these kinds of valuations seems enticing to me, but I've been saying that for months and they keep going down. So Riocan, for instance, is expected to do about $1.80 in funds from operations. So they're trading under 10 times earnings here. It's just impossible to buy the types of assets in the cities and in the downtown cores that Riocan has assets in and have a 10% cash flow yield or 10% total return. So I just think it's a huge mispricing in the public markets versus the private markets. I think Riocan's net asset values in the mid to high 20s, like 26 or so. So it's trading at about 35% discount to what the underlying real estate is actually worth, which is a really interesting opportunity, especially with how expensive and how hard it is to get exposure to real estate from a physical sense in the major markets in Canada. You see here that $1.80 of EPS expectation for next year. That's actually the same number as their funds from operation expectation for this current year. There's always a bit of a discrepancy between EPS and funds from operation with depreciation and change in asset valuations and things like that. But Riocan's pretty much trading at a 10 times or almost a 9 times earnings multiple at this point. Historically, they've traded 14 times, 15 times. So I'm getting a really nice discount. Once again, I get part of the justification, rates higher, better alternatives in terms of cash producing assets. But I think that these assets will do very well long term, will grow long term. And I like the idea of kind of continuing to nibble in on these discounted prices. Next up, we got Air Canada. Air Canada stock has collapsed in the last month, down 13%. It's a lot of things going on here. First of all, fuel. Fuel is airlines' number one business expense. Just it's obviously required from getting people from point A to point B in planes. So with kind of some of the things going on in multiple areas of the world, the price of fuel has just gone up a lot, and the expectation for the next 6-12 months on fuel has also gone up. So that's been a bit of a headwind for Air Canada. In addition to that, we're starting to see some airfare prices trend downwards. Now, I think this was somewhat expected. They had a very profitable last 12 months with people revenge traveling and going all over the place. So it's correcting a bit, but I think that correction is coming in faster and maybe harder than some investors initially thought when the stock was trading up earlier in the year in the high 20s. So that's something to keep an eye on. And then more broadly speaking, just discretionary spending. Will people be able to go on the same amount of vacations? Will people be able to upgrade the business class to the same extent as they were before? Lots of these concerns, if they get realized, will have a real impact on Air Canada's bottom line. With that being said, just looking at the company on a trailing aspect where they just had a perfect year off of those horrendous years with the pandemic and whatnot, they're expected to do about $3.75 this year. So the company's trading at about 5 times, less than 5 times earnings here, which makes it really interesting. That's tons of cash that they've actually been generating over the last year that they can upgrade their fleet. They can pay back lots of the debt that they took out in the prior couple years, especially if they deliver $3.70 in 24. That's pretty much $7 of cash that they've generated on an equity price of $17 that they can use to pay off debt, really position the business for lots of strength for the next 5 years, 10 years. So we'll see how fast the economics of airlines kind of get degraded here. But hopefully if they're able to keep up lots of the momentum, lots of the results they've had in the trailing 12 months, this could be a name that could go up a lot from here potentially. Going into the next stock here, it is TFI International. TFI International is a shipping company, down almost 10% as well. They pay a 1% dividend yield, $13 billion market cap here. They operate all over North America. And you can see here, this has been a phenomenal stock over the last 5 years. I think they've had a lot of acquisitions that they've really tucked in and synergized really well within their operations. And they have compounded the value of the company exponentially, up almost 300%. So these dips don't happen too often if you look at the stock over the last year or so. You got one dip here, and then this is really the second major dip. So if it's a stock that you're interested in or you want more exposure to the logistics space, but you don't want to own a railroad or you already own a railroad, this may be an interesting opportunity for you. From a multiple standpoint, expected to do about $11 next year, which would put them at about a 14 to 15 times price to earnings ratio if they actually deliver that. So it's trading cheaper than the railways. They own lots of trucking infrastructure within their business, but also some other elements to their logistics franchises as well that I urge you to look into. The next stock, I've talked about Scotiabank a lot over the last year or so because I do own this stock. It's been a painful one, but I got to bring it up again because it's down another 10% this month, currently trading at a 7.3% dividend yield. In terms of earnings per share, they're expected to do over $7 next year, so they're trading at under 9 times earnings here. Under 9 times earnings for a bank that has increased their dividend almost every year over the last 50 years with a really defensive spot in the market, since it's essentially an oligopoly with all the other big banks and primarily operating in Canada with some exposure to Latin America. I think all of the banks, to be frank, are a bit undervalued at where they're trading and where their yields are and their cash flows and their growth history. This is just the one that I decided to put in because it's down over 10% here over the last month alone. Going into Finning International. Finning International is a construction equipment wholesaler or seller here. You can see they're down about 6.5% this month, trading at a 10 times trailing price to earnings ratio. They do pay you a nice dividend there too, just a 2.5% payment. Looking at this one long term, it's done really well over the last 5 years, delivering about 40% growth on top of the dividend. Looking at earnings per share estimate, right at $4. So similar to this year, expected to deliver about 10 times earnings again if you invest in this one. You're getting obviously that 10% overall return. It's getting divvied up in a 2.5% dividend. And then I also think they may buy back some shares with some of the remaining cash flows before investing the rest of the cash flow that they generate from operations back into the business for future growth. So this is one that I imagine has some level of cyclicality to it, as well as people are building more things. Government is building infrastructure, updating infrastructure. This company may do significantly better than in a downturn and projects are getting canceled. Interest rates are high. People don't want to be developing. So you do pose some of that risk with a name like that. And we're going to get into the last stock here, going over the last month. GFL Environmental, which is essentially a garbage company that operates in Canada here. Once again, I got the US ticker up by accident. Let me get the Canadian one up. Is down 10% in the last month. So pretty, or 8.5% on the Canadian exchange. They pay a nominal, irrelevant dividend, so I don't really consider it. But hopefully they continue to double and triple and quadruple that over time, since it's such a small part of their capital allocation. But down 10%. This is another one that has done really well, and you have a hard time buying it on dip since it went public in 2020. It's essentially doubled from there. But you see here, it was up at $50 a couple times. So if it's a company you believe in for the long term, you're at least getting a nice little 10% give or take dip on it here. Still really expensive company here. Expected to do about $1 next year in EPS, even less than that. So it's trading at about a 33 times future multiple. But there's other companies in this space that garner really high multiples. Waste Management is the largest one in the US that comes to mind. You can see here, this one's trading at 28 times, and this one has a lot less growth opportunity. It's a $63 billion company. So that's just the premium you pay for a company that's in this industry, given the moat they have. Really hard to break into this space. Obviously, you need government contracts, you need a lot of other relationships and stuff with the cities, and to scale it up to a spot where you can be delivering net income and profitability and expanding on it, really hard. So it's in a really good defensive space. Garbage will continue to be produced. If not, more garbage will be produced as populations increase in these areas of the world. So they're servicing a growing market. That's why, in my opinion, paired with the moat, that the multiple is so high. So not one that I'm personally interested in, but still an interesting stock to take a look of, especially down that 10% this month. So those are the stocks I'm talking about today. 12 Canadian stocks that are down big this month. Let me know which one of these stocks you're interested in or you may be buying, or if there's other ones that are down big this month that I did not cover in this video. Would love to hear from you in the comments. If you made it to the end of the video, be sure to give this video a big thumbs up. I can't say enough how much it does help me out and how much I appreciate it. And if you also haven't yet, be sure to subscribe to the channel. Thanks for watching, and I'll see you guys in the next one.